globally. And I think you guys did Uber, Airbnb, Bolt,
Spotify,
among many others. I'm curious, how does that work? You're a family office, you have a great reputation across the region, but then how does Uber come to your desk? And do you even speak to the founders, or is it an SPV through an SPV?
I don't think you mess with the VC model as it is, right? It's done well in all geographies, including countries that have similar risks and similar currency fluctuations, such as LATAM, Mexico, Brazil. I'm not sure you need innovative VC models to be able to specifically tailor it for Africa.
Really? Hello, Internet, and welcome to episode 11 of the RallyCap podcast. My name is Kyane, and I'm a general partner at RallyCap. Today's guest is Hisham Halbouny, who's a managing partner at P1 Ventures. P1 Ventures is a $50 million Africa-focused fund, who's often referred to as a contrarian investor. I truly enjoyed getting to know Hisham and learn about his impressive background, having invested in the likes of Uber, Airbnb, Spotify, and Bolt in his previous role as a partner in an Egyptian billionaire's family office. Are you intrigued yet? Let's get into the conversation. Hey, Hisham. Thank you for hosting me in your house.
No, it's lovely having you here.
So before getting into the portfolio in itself and some of your bold decisions, I want to quickly touch on your personal background and also how you switched to becoming a GP in P1.
So originally, I started off being a banker for way longer than probably anyone should have, about 15 years doing investment banking. Then in 2015, moved from what they call the sell side to the buy side. Joined the platform out of London called Man Capital. It's a phenomenal platform. It has a global reach.
Maybe for those who don't know, Man Capital is the family office of the Mansour family.
Absolutely, yes.
Which is one of the richest families in Egypt and in Africa in general. And they invest globally. And I think you guys did Uber, Airbnb, Bolt,
Spotify,
among many others. I'm curious, how does that work? You're a family office, you have a great reputation across the region, but then how does Uber come to your desk? And do you even speak to the founders, or is it an SPV through an SPV?
Sure. So look, I think Man Capital is a very special beast. First of all, it has a very stellar reputation, and it's a global reputation. It's not a local reputation. This has been compounding over decades and decades, and it has a phenomenal network. And you don't get Airbnb knocking on your door except in a pre-IPO. But what happened is we actually went to the Bay Area. It was a proactive move, and the chairman had a great conversation, and we invested directly on the cap table there. Uber is the same thing, right? And actually, Uber is a relationship that we've built, and we invested across many series. And even the chief business development officer of Uber back then, Emil Michael, we built a great relationship. Now he's an advisor to P1 and we work closely with him. So relationships matter, access matter, and it's all because you have built decades of reputation.
And what do you promise them? Do you tell them we can help you open up Middle East for you?
We can be your access, your eyes, your ears, and how to navigate Middle East, Africa for you.
And then maybe a question that you get a lot is that once you have exposure and track record into those global, well-known, everyone knows these deals, brand logos, how come you're doing Africa investing? And also what mindset shift does that require?
No, absolutely. Look, I'll tell you. Look, the beauty of Man Capital as well as a platform is we build and we invest. So we've invested in those category-defining businesses, globally huge successes, but we also build businesses. So I built diagnostic centers across Nigeria, asset-backed financing businesses in Kenya, Egypt, Ghana, microfinance business in Egypt for the platform. So you're building locally in our home markets. We understand those home markets. We're differentiating home markets. And because I come from those markets, I understand them pretty well. Building is hard. We know what it takes to build those businesses. But shuttling back and forth between the US and Africa is like, okay, I've noticed a few things, right? It's like repats are coming back to build. That was pre-2021. More capital was flowing in. And I've seen this play out before, whether it's in LATAM, whether it's in India. You call it by they're 5 years in advance, 10 years, 20 years. It doesn't matter, right? The trends have already started. And I thought, look, I think these are undeniable arrows of change. This is only going one way. And that's just the beginning of it. I don't think we're too early. I don't think we're late. You're at a time where you can actually build a solid brand that has a good reputation, that's generational, that can focus becoming the partner of choice for those founders on the continent. And the timing, I think, is absolutely right. And look, the capital ebbs and flows, but despite this winter, no, you've had capital coming in.
Yeah.
Despite the pullback from the soft banks and the tigers, you have bond capital came into the market for the first time. You have Excel pouring money into the continent. So you're seeing recycling actually of more sustainable, in my view, pools of capital coming back there. And you're also getting capital formation on the continent. So I think the opportunity here is massive, and the amount of value that's going to be unlocked is just outstanding. And we have an edge because we know what it takes to build those great businesses, what greatness looks like by investing in those companies, being close to them, what the metrics look like, right? And then we also understand the local nuances and what needs to happen in our home markets for those guys to come in. So that's what drove us to actually launch our first institutional fund now. The first one was a proof of concept. Does this make sense? Are there category-defining businesses that can be built? Can you hit large outcomes? Is the flywheel effect kicking in? Because as it starts with one success story in an ecosystem, and then it's like, okay, that's inspirational. I also can do that. And you find teams spinning out. So that already started to take place. So I think it was a difficult decision to part with such an institution, all the friendships and everything that comes with it as well. But it was also easy because it was so clear to me what's unfolding now and what's going to unfold on the decades to come. To be part of it. It's not an easy ride, for sure. It's not for the faint-hearted, but the returns are there, the businesses are there, and hopefully we'll get to harvest them in the near future.
Yeah, the question of timing is a tough one. And the problem with timing is like if you're too early, your return is zero. And if you're a little bit late, then it's suboptimal. So you really have to be at that first wave to outperform. But when you're looking at these global VCs, and we speak to a lot of large US VCs who after 2021 moved back to their priority markets, wouldn't it make sense from their perspective that you should actually go against the current and that when no one is investing, you should actually be investing so that you can reap the benefits later on?
100%. And that's why we're investing, and that's why we launched an Africa strategy, right? This is probably going to be one of the best vintages, I think, in history for the continent. It's just everything is pointing towards that direction. The global VCs are pulling back because most of them are not really global. They are US focused or Europe centric, and then they have a pocket there. So the flight to safety tends to kick in because they also have turbulence. It's not only an African thing, it's home market, it's what's happening, it's a lot of things that are happening on the AI, you have a super cycle coming there. But when you have a truly exceptional business, no, people listen and people take note. And we recently, hopefully we'll announce them soon. We have 2 deals that are going to be announced. Both are led by top-tier global VCs.
Now I'm curious about fundraising. We talked about global VCs retracting. I think the best way to prove them wrong and also bring FOMO again is to say, you know what, we're going to build it ourselves. We're going to raise more local AUM and do our thing. But the problem is the lack of options within LPs, and everyone is getting back to the default option, which is DFIs. So first, you haven't been an LP before in a family office. Why aren't they more non-DFI LPs investing in Africa?
I get it. DFIs is, I want to say, the easy choice. It's not an easy process. And
it's the default choice.
But they are the ones that have programmatic systemic allocation to this part of the world. They need to deploy X number of dollars per year to Africa. The family offices, no, for them, you have a global opportunity. If they think there is value in that asset class at that vintage, they're going to come in. But the DFIs, no, they have to invest X amount of dollars into that strategy in this year. And then they identify their strategies. And honestly, I think if you align with some of those DFIs, I think you should be fine. Our DFI, it's IFC, and they've been great partners with us so far.
And the reason I'm bringing DFIs within this context is that there's always discussion about, is VC the right asset class for Africa? And you should come up with alternative models. And some say, we should raise local currency funds. People come up with so many ideas. But since the main LP is DFIs don't have the flexibility to play around with new alternative models. They have their way of doing things. So you're going to keep raising 10-year funds, USD denominated. That's just how it plays. So you haven't been in different positions across the spectrum. What do you think an alternative or a better version of African VC would look like?
I don't think you mess with the VC model as it is, right? It's done well in all geographies, including countries that have similar risks and similar currency fluctuations, such as LATAM, Mexico, Brazil. You have all those fluctuations, right? And the VC model remains as is. I'm not sure you need innovative VC models to be able to specifically tailor it for Africa.
Really?
I genuinely don't think
Okay, so we have a good topic here, because these are the pushbacks here. One would be that power law doesn't work the same in Western world than in emerging market or African VC, because these are less risky businesses, but they would reach a certain size. They might be more like mid-cap businesses and not necessarily too many breakouts, right? So you don't need one company or two in the portfolio to return the whole fund. You just need a nice portfolio mix of small companies, mid companies. So that you don't believe.
I don't believe in that. This is a power law business. You are in the business of backing exceptional people, building exceptional businesses. Having a medium return doesn't make any sense. Who buys you at a medium return? What type of valuations will they pay for it? It becomes very difficult to do that, right?
Sure. The second pushback on the traditional VC model is the 10-year fund cycle. Things happen way more faster in Western countries, but in Africa, you don't expect that kind of breakout companies within just 10 years. And also you can't force a sell as easily because of the illiquidity of the market. And also even in the US, where we're looking at the highest returning funds being 15, 17 years fund. That should be even more in Africa.
So it's the same thing. You're not changing the model. So in the US, you just alluded to, sometimes you need to extend the fund life. This was going to happen in Africa. If you need to extend the fund life, you're going to extend the fund life. It depends on the vintage and it depends on the environment that you're investing in. When the windows are open for M&A and IPOs, those would be shorter windows. And actually, if you take a step back, most of companies have been now held for longer in private, right? So this is more of an international global phenomena than an Africa specific phenomena. It has nothing to do with the model. The model still works in that sense. And if I take a step back, let's take Yassir as an example. It's a short window until you hit a significant outcome. So if you take the time of building a $600 million business to $1 billion plus business, if you take that, you find that actually the time has shrunk from 16 years to 7 years to 4 years.
Yeah. And the 16 would being like an interswitch. Fowry also took its time. So those were the reference numbers that we were using. These things take way more time than VC, but it's true that...
And then Flutterwave, look at all those, right? OPE, it took much less than the 17 and 15 years to build those.
So morely like 4 or 5.
So the problem is DPI now, right? Which is a global problem again, but obviously more pronounced in our part of the world, because what we lack is a unified exchange where we can list our assets. Until we figure this out, it is going to haunt us for quite some time. And that's why we think that VC, early stage VC, is probably the best place to invest in Africa. That allows us to actually partially monetize along the way. We lock in returns, we can have distributions, and leave a bit of upside for the market to de-risk and eventually give us the fund returns.
Now I'm curious about models or spaces that you think are just overrated, overfunded. I'm just curious about the open skepticism of VCs towards specific models.
Look, in general, because of our models, our fund model and structure, we're seed stage investors. We don't necessarily have the firepower to follow on a lot. So we shy away from capital intensive businesses just by default. Other than capital efficient businesses are phenomenal businesses. So we do the exceptions, right? So we'll always do the exceptions, right? But they are the exceptions. The norm is, no, we want capital efficient businesses. We don't need to, because of our stage and our check sizes, we don't want to be in a business that we get significantly diluted by the time we exit. We just barely own a stake in the business. So there are business models out there that actually are capital efficient and have a good margin and don't need that much of capital to grow. Let's look at software. Absolutely, software has been initially, adoption has been low. ACVs are quite low in this part of the world. But we genuinely believe that, again, back to our core thesis, talent is distributed. So we think there are talent pools that are based on the continent that can ship global software that can be adapted anywhere in the world. We already backed a business out of Morocco that effectively does that. Right? It's based in Morocco. They have a global reach. They process in the billions of GMVs, gross booking value, GBVs, for their customers in the hospitality tech space. And they're based out of Morocco and they have a global TAM. Their biggest clients are Nubank in Brazil, WeChat in China, Capital One in the US. So you don't have many of those, but we don't need many. We're not trying to solve for the average. We want a few, and we want those guys that have a shot on target to be able to actually deliver those outstanding returns. We did another business out of South Africa. It's a SaaS play for DevOps and DevSecOps. So it effectively consolidates the tools that a DevOps engineer needs to have rather than using 15, 16 tools. And there's scarcity actually of that engineering talent. So it's augmenting their ability to roll out their software development lifecycle without having to use too many tools and assisted by AI. So it's cutting the time for you to do that by more than 5 times and enhancing your productivity significantly. And I think the whole infusion of AI and this super cycle of AI that we're living in, I think is going to make it much more easier for SaaS-powered AI solutions, which is going to be native. So there is a leapfrog opportunity from a SaaS perspective for adoption in our part of the world, because it becomes not only am I optimizing on costs and efficiencies, but I'm also significantly increasing the productivity. And if you can do this and acquire them at a low customer acquisition cost, if you have a product-led growth motion, for example, it becomes easy for you for them to adopt it, because then your CAC is low and your ACVs are, even if they're not huge, they're still sizable enough. For example, Gameball is another business we invested in. Does gamified loyalty and gamified customer retention solution. It's a software business, and they sell probably to 70 countries today, based out of Egypt. So there are those. You just need to work harder and try to, and it's not easy, right? But again, I don't think we're in the easy business.
And let's switch gears to your personal investor evolution. What was your initial mindset being an investment banker, moving to family office? How did you adapt? Do you have some mental frameworks or maybe some intellectual hygiene to be able to stay square in your thinking? And then moving to pure VC now as a GP, what are some of the reflexes that you need to unlearn?
Great question. Obviously, in banking, it's velocity, right? It's a lot of deals. You do the deal, and then you just need to go do the second one and the third one. It's how you earn your living. In investing, in the family office, you do the deal. It's a lot of hard work. You win the deal. You compete for it. Then once you own the asset, it becomes... Now the work begins. It's not about just getting and winning the deals. Okay, now we win the deal.
Now you have a baby and it's a responsibility.
Now you need to grow it. You need to make it big. You need to work on recruiting, expansion, financing. That was a big shift in my mindset. And the beauty of the platform I was with is we're not only investing, but we're investing with a very long-term mindset. So that also, having that long-term mindset was a big shift for me. As a family office, we don't need to sell. If we like the assets compounding nicely, we keep it forever. So there's no pressure to do that. And being disciplined and having that mindset, this longevity journey was a big shift. Building is hard as well, because we build businesses at Man Capital. So that taught me a lot. And the intersection of building and investing is what got me actually quite passionate about, okay, you know what? I like seed stage. That's the area where actually I'm most passionate about. This is where I like to show up every morning, right? And adding value. I'm not the management team. I'm not running this business, but I am there right next to you to support, to think through, to help open doors, to effectively, remove some of the obstacles if I can. This is the area where I actually enjoy the most. So when shifting to VC and doing seed was natural for me. It was obvious. And the biggest learning here was there's no downside protection. There's nothing called downside protection. It's zero. It doesn't matter. The losses or the 1-2x's, I don't say they don't matter. They matter. They hit you personally. But from a returns perspective, this is a pure upside game. So you need to make sure that every shot on target, every single partnership is worth it and can get all the way through. So that was another big mental unlock for me, and I'm still working on it.
I have to say, always had a lot of respect to P1, and I'm glad we finally get to sit down. So thank you for this. I'm sure the golden era of African VC is ahead of us.
Thank you, Kyane.
Happy to have you as a partner in this.
Thank you, Kyane. And we always think of RallyCap as a great partner as well. You guys have awesome deal flow, so look forward to partner with you on many deals to come.
Cool. Cheers, man.
Cheers.